What is a mortgage? Well, in this video, we're going to be taking you through the basics to help you in your buying journey. Hi, this is Sam at Rosehill Financial Services. We're specialists in mortgages for the self-employed. If this is your first time watching us, I hope you do find our content useful, and please do share with anyone who may benefit from watching too. A mortgage is a loan from a bank or a building society which helps you buy property. If you're buying property in cash, there's obviously no need for a mortgage, but if, like most people, you can't afford to buy a property in cash, you're going to need to take out a mortgage to cover any shortfall there might be. So for example, if you're looking at buying a property for £400,000 and you have £100,000 to use as your deposit, you're going to need to take out a mortgage for £300,000. Typically, a minimum deposit for a residential purchase is going to be around 5%. However, this is going to vary from lender to lender. So there's many factors that are going to be taken into consideration when working out how much deposit that you actually need. So there's two types of repayment methods. You either have a repayment mortgage or an interest-only mortgage. Now you can have part and part, but for the purposes of this video, we're going to keep it nice and simple for you. For a repayment mortgage, you'll generally make monthly payments to repay the debt, which is known as capital, but this will also include interest payments as well. Now the interest will depend on the actual deal that you have for your mortgage. So this will either be fixed, meaning the payments won't change month on month, or these will be variable, meaning that the repayments can go up and down. With a repayment mortgage, assuming that you've kept up with all repayments, your mortgage debt will be cleared at the end of the mortgage term. With an interest-only mortgage, it's a little bit different. So you won't actually be paying back any of the debt on a monthly basis. You'll only be making payments for the interest owed. This will mean that your monthly payments are lower on an interest-only mortgage, but you will have to work out how you're going to repay this debt at the end of the mortgage term. A couple of examples for this will be to have an investment fund which is separate from the mortgage to help you repay that debt at the end of the mortgage term, or you can look to potentially downsize and sell your property to pay off this debt. Of course, an interest-only mortgage is a riskier method because if you're looking to sell the property, for example, there's no guarantee that you'll be able to pay off the debt with the sale of the property, depending on the property price at the point you come to sell it. So as mentioned earlier, there's different types of interest rates that will apply to your mortgage. A fixed interest rate means that the interest will not change month on month within that fixed period. So your monthly payments will be exactly the same for 2, 5, 7, 10 or 15 years, however long you look to fix for. At the end of this fixed period, you will then generally fall onto the lender's standard variable rate, which is generally higher than that fixed interest rate that you had. But these fixed interest rates do protect you from potential rises in interest over the next few years. Fixed interest rates will also usually come with early repayment charges. So if you do look to pay off the mortgage debt, so say if you move home or sell your property, you may find that there's quite hefty early repayment charges that are applicable. However, there are some lenders that will allow you to fix in for a mortgage but have no early repayment charges at all. So there might be a small exit fee, but you wouldn't be looking at the hefty fees that many lenders do charge. It's also key to note that you may be able to port your existing mortgage to a new property when you're within that fixed interest period. So this is a way to avoid the early repayment charges when you are moving home, but you just would have to fit the criteria with that lender at that particular point in time. A variable rate such as a tracker or discount rate means that the interest can change month on month. So you may find that there's months where you're paying a higher amount on your mortgage, but if interest rates do drop, you would benefit from the lower monthly payments. We're not going to go into too much detail on the different rates available in this video, but I will be making another video very soon just going into more detail for you on this. So the mortgage term is essentially how long the mortgage runs for. So you may hear that a typical mortgage term would be 25 years, but this can be longer or shorter depending on your circumstances and what your aims are. A longer mortgage term will mean lower monthly payments, but you will be paying more overall in interest over the full mortgage term. That's because the monthly payments are spread out over a longer period. So each month you're paying that interest. If you choose a shorter mortgage term, you will be paying more each month, but you will be making a saving on the overall interest paid. Many lenders can be flexible with the mortgage, so you can make overpayments on your mortgage, generally up to around 10%. But it's best to check this with your particular mortgage product so that you can avoid any unnecessary early repayment charges. But using this overpayment facility can allow you to pay the mortgage debt down more quickly than the actual mortgage term that you applied for. One important thing to note is that a mortgage is secured on your property. So if you don't keep up repayments on your mortgage, the lender can repossess your property. For this reason, I highly recommend speaking in detail with a broker just to go through affordability both now and in the future to work out what mortgage product is best for you. So I'd love to hear from you. Are you looking to buy your first home? Please do let me know. If you'd like any further information at all, please don't hesitate to drop us a comment or leave me a message personally. I'd be happy to help. Thanks again for watching. I look forward to bringing you more content like this in the future, and I'll see you in the next one.